Yeah, having said that, I think for your listeners, a lot of your listeners are multifamily people. I do have
Hmm.
some good news to share. In the last 6 or 7 years, each year, we've looked at all of the industry reports, whether they come from Marcus and Millichap or Berkadia or CBRE or 10 other sources.
Hmm.
We put them into a grid because each year, each one of these big companies says this is the asset class that we think is the strongest, right? And they rank all the different asset classes, good, better, best, that sort of thing.
Hmm.
And of all the asset classes, the average winner in the last 6 years has been multifamily.
Hmm.
So it has been, and 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 it's actually been in number two position most of those years. So currently,
Right.
the most favored asset class for the last 2 years, pre and post pandemic, is industrial
Sure.
because we've had 5 years of e-commerce growth in 10 months.
Hmm.
And so when you have 5 years of growth in 10 months, there's a shortage, right? So obviously
Absolutely.
we're roughly 125 million square feet short on the e-commerce side in terms of space. And I'm sure that pace is not going to lessen. We've had 50 million Americans that really didn't use the internet for e-commerce that are now using it. And so it's
Right.
going to take a while for that to mitigate. So industrial number one, multifamily again number two. Now in the past, pre-pandemic, before the industrial sort of took over, there was self-storage. There
Hmm.
were mobile home parks. For a brief amount of time, there was senior housing. While going a while back, 6 or 7 years back, there was student housing.
Yep.
So it's very rare to see multifamily as the most favored asset class in any given year. But if you average it out over 7 years, it's the winningest class. The
Yeah.
consistency is remarkable. And that's why we've had multifamily as our foundation. But
Hmm.
then we play in these asset classes that we think are better. We've done self
Hmm.
storage, we've done industrial. And we also have played beyond these asset classes into something that is very rare, which is townhomes. So we build townhomes from scratch because while multifamily, industrial, self-storage are well-known asset classes in syndication, which is a process of gathering investor money, it's they're none of them are the most profitable for the end investor. And the most profitable for the end investor is to basically buy scaled townhomes in scaled communities. And we've known that for 6 or 7 years. We just didn't have a business model where we could get paid,
Hmm.
right, for investors to do that, because the whole point there is 100% ownership, 1031 benefits, in
You're
its
able
scale.
to.
Because the problem with single family rentals is that you have to still deal with a property manager who has 700 more units,
Right.
and you don't know whether they're paying attention to you or not. But when you build a 133 unit townhome community with
Hmm.
its own property manager and its own maintenance staff,
Right.
then you own your own property, you get the 1031 benefits, you get the long-term depreciation, the long-term equity benefits, but you've still got all of the multifamily benefits because you're inside a multifamily. It's a very difficult process. It took us
Gotcha.
about 5 years to build the systems to do that, but
Hmm.
but it's just an example.
No, it's
Obviously,
interesting.
I'm not saying that that's the focus, and most people should not even try to do that, because you need to reach a very large scale with investors, because
Hmm.
these are $1 million or more each. So,
Hmm.
the minimum investment is 250, right?
Hmm.
So you've got to have an investor database that is enormously large, right? So we use technology. We've built what we believe is the second largest investor database in the US for syndication people. The largest is Grant Cardone's database. And so we eventually got to the point where we could have enough investors that will give us 250 to 300,000 2 years before these things are built, right?
Hmm.
Because there's a 2 year gestation period. So bottom line though is I wasn't really talking about townhomes, but what I was
Right.
talking about is that we study asset classes from the perspective of the investor that's investing $100,000 in syndication. Multifamily is rarely number one, but it's the foundation. It's overall the best. We
Hmm.
also study what's best for the investor. And it has been a 5 year obsession to come up with that model where the investor still keeps 100% of the profits and we still get to make something, right?
Hmm. Hmm.
And the model was to basically build these enormous communities where everyone owns their own fourplex. That way, they're not your partner, you're not their partner. They still enjoy benefits for 30 years. And that model
Interesting.
unquestionably beats every other model in terms of the amount of profit, the post-tax profit that the investor makes. I've never seen anything like it.
Hmm.
But it took 6 years to get to that point. And along the way, we made our investors plenty of money, and we continue to do syndication simply because, as I said, 1 out of 20 investors in your database will even consider buying a fourplex and putting that kind of money down. Most people want $50,000, $100,000 investments. That's kind of the middle of the fairway. So we continue to do industrial. We just did an industrial project about a year and a half ago. We did a self-storage project about a year ago. They're both doing beautifully. We continue to do new construction, multifamily. We continue to do value add, right? So I did branch out of value add because, and this is, I mean, people who've been listening or binge watching podcasts, you guys know this. We all know that the market's really expensive. We know that there's no historical precedent for the price per door. We know that Class C units shouldn't really sell for $120,000 a unit. Even in good markets, they shouldn't sell for $120,000 a unit because you can construct them for $170,000 a unit, and there shouldn't be just a $50,000 delta between a 40-year-old building and a new building. That delta does not make sense. There's no doubt in my mind that there's a compression that has happened. New construction prices have gone up, but Class C prices have gone up much faster. Therefore, the gap between new construction and Class C has closed and continues to close. And that creates risk. That creates substantial amount of risk because, like, a lot of people right now are forecasting that they're going to buy this Class C 40-year-old property at $120,000. So that 120, they're making the assumption that they can sell it for $170,000 or $180,000 a door in 5 years. My question is there any historical precedent for anyone that has sold? The building's already 40 years old. So 5 years from now, it'll be 45 years old. Who is the person that's going to buy this for $170,000 a door? When construction prices 5 years from now will be $200,000. So now there'll be just a $30,000 gap between a 45-year-old building and a brand new building. And I don't think that it's the number of syndicators, Kent, that is the issue. It's the number of inexperienced syndicators who have not faced a market where cap rates have gone up, right? So cap rates have only gone down in the last 8 years. So everyone's been cushioned by that. And that's a zero-sum game. It ends at some point and then it reverses. And I think that there's not enough people that have seen that, experienced that, or understood what the kind of impact that would have on them. And so that's what makes me worried. And if there are going to be such people in this marketplace, and the Fed is going to continue to be as benevolent as they have been to us in the last, if let's say they're benevolent for the next 3 years, then my take is I'd rather be a seller. I'd love to sell in this market. So I'm building and selling, and people are buying the stuff that I've completed construction on at truly hideous prices. But I'm happy because I'm on the seller side.